Well, Karen and Steve, thank you so much for having me on the show again. Wow, I don't think there's much weakness to talk about here. We had a record first quarter, 8.3% net sales growth in constant currency. In aesthetics, we grew almost 10%. In the business you talked about, dermatological skincare, almost 8%. And we launched Nemluvio, and we're already at 39 million in sales and 5% almost growth in the therapeutic dermatology, which is the category where there is. So I think very strong double-digit international growth, and the US, most importantly, turning to mid-single digit growth. So I think really a very strong start, not only a record, but a very strong start. And it sets us up very strongly for the year, despite tariffs and everything. So we confirmed guidance at 10 to 12% growth in constant currency. And we also said we're confirming the margin at 23%. So I think a very strong start to the year.
Flemming, let me just ask you a little bit more about the tariffs then and the impact on the global beauty market from those border taxes. I know you have a very international footprint, but you do play in the United States. So just tell us what impact you think the tariffs will have on the consumer with some of the uncertainty we're witnessing.
Yeah, I think we can only look at the facts as we have them today. And we think what we see is absolutely manageable for us, which is why we confirmed our guidance very strongly. Only a very small part of our portfolio will be exposed, as we see it today, to tariffs. About 9% of our sales are in U.S. fillers and biostimulators, and currently there's about a 10% tariff on that. It could go up to double that, but it will be not on the full net price. It will be on the transfer price. So as we've said, we really think that it's very manageable. It's also important to realize that in the aesthetics market, 90% of all products that are sold come from outside the European Union. They come from the UK. They come from South Korea. So we see that as totally manageable.
Flemming, one of the reasons why, nice to see you, by the way. So your shares have had a tough time since their peak in February. Do you think that's over now, that period? That we've had the end of those lockups as well, and those sellers, including Abu Dhabi and EQT, selling down holdings as well. Do you think that period of institutional investors selling is over?
That's difficult for me to comment on because I don't have dialogue with them about that. What I see is that we have significant interest from new investors. We've added a lot of high-quality investors. I think with these kind of results, even if there is more sell down, we'll manage that well. We managed the last sell downs very well. I think the outlook for the business is incredibly strong. So I'm very confident both in managing the tariffs, but also managing potential further sell downs.
I mean, I suppose that's the problem of the mix that you have at the moment. Of course, sellers retaining, I think, 48.2%. Free float has gone up to 42%. I mean, just from a corporate point of view, I know this is a kind of in-the-weeds kind of question. Would you prefer a larger free float with a smaller holding from those top 10 shareholders?
I think we had 280 investor interactions in this quarter. So, of course, as we go through this transition from being private equity owned to now being a publicly listed company, there is a transition. You need to attract new shareholders. And I think if I look at our shareholder register, I'm really impressed. We have very, very high quality share registry. And I'm absolutely sure that I see a lot of interest. And I think with these kind of results and with the outlook, and with the outlook for continued very strong growth, remember the growth will accelerate this year. I'm very confident we can also attract new investors or existing investors will add to their portfolio.
Flemming, I wonder